Greetings. My name is Torrey Muhammad, the founder of Bean Soup Media. We are a content and digital marketing strategy company that empowers the brands of small businesses. We are a passionate team of designers, writers, photographers, and most importantly, problem solvers. And we come together to help you tell your story.
Brother Torrey, you shared a post about our business a few years ago. It's reached almost 50,000 people within about 30 days. Brother Torrey, through yourself, we have had so much media coverage, newspapers. We're talking about the Channel 7, Channel 9. You have brought so much attention to Sean Michelle's homemade ice cream, and I will never stop supporting Bean Soup Times and Black Chicago Eats. And I wish that others will also take a closer look what you have to offer, because we have benefited. Just take a look at Sean Michelle's. Take a look down the street. See the line to the next block. That's as a direct result of the social media that you posted. That's as a direct result of the live testimonies that you've done at Sean Michelle's. That's as a direct result of the writings that you've written up on Sean Michelle's homemade ice cream. And so God has really blessed you first to have a love for our community, to have a love for black businesses, and one for your brother, which you want for yourself.
In the building with us is Brother Torrey Muhammad. He is the marketing genius behind Sissy's Taco. But Torrey has been one of the pioneers in marketing, black marketing in Chicago. He did the, was it Black, not Black Chicago? Taste of Black Chicago. Doing it like the real, for y'all real marketers out there, bring us the food in the morning. I'm telling you. And then I just had some gummies too. Oh, my cousin.
And they warm.
I'm selling, you got the studio all smelling up. Brown paper bags. Torrey Muhammad, you see him, check out Bean Soup Times. Check him out, all of his clients. Also, let me tell you what, he also represents Sean Michelle, right? So check him out. He's also, man, I know let me tell you what, shout out to Sean Michelle. You know I'm an ice cream connoisseur. So I love that ice cream. But boy, that line, oh Lord, you got the market right here and sit there and it be like down the block. Shout out to, and he also is a writer over at The Final Call, right? So Brother Torrey Muhammad, extensive history, doing it like the marketing directors. So I'm gonna tell y'all what, Sissy's Taco Bar doing their thing, popping up on a Friday. We're gonna be smashing these on air. Torrey, thank you so much, my brother.
You guys, Brown Sugar Bakery has been using Bean Soup Times since 2009. We established our Facebook page 11 years ago. Look at that. We've grown as a company, and with Bean Soup Times, he's always been looking out for us and enticing all of you. I love you, Torrey, for enticing my wonderful customers that are both Facebook fans and Instagram fans. I highly recommend Bean Soup Times, especially if you're brand new to social media or relatively new to social media, because Torrey will make sure that he kindly and patiently walks you through getting up to speed online.
Linda. All right, what's going on? What's going on, family? This is your brother, Torrey Muhammad. I hope that you are doing well today. We shaking and moving today, man. We're here at the Woodline, and I'm here with my brother, my cousin, my mentor, my teacher in real estate, Pashan Jamal Julian.
Good day, everybody.
What's going on, brother?
Hey, man, happy to be here on a happy hump day talking about real estate, one of my favorite topics, and definitely know that it'll be a positive thing for those that listen. They'll get some valuable information.
Man, absolutely, man. So I really appreciate this. We wanted to do something to help people who are first-time home buyers, right? I get a lot of questions, and it's amazing, you know, how often new people are entering into the market that don't have any clue of what to do and need someone to hold their hand, despite all of the, you know, the stuff that people can try to figure out online, and you can Google stuff and you can go to these sites, but, you know, we don't realize what we don't know that we don't know, right? And you got to have someone for this critical step where for many people, this is going to be maybe the biggest purchase that you make, right? You want to have people who know what they're doing, and you want to have people who can help you put together the right team, right? So what we're going to do in this session is kind of walk through some of the things that you need to be aware of, to look for, and to understand about the entire process. So this is, like I said, this is a brother who has been teaching and coaching me along the way. I haven't ran into a problem yet that he does not have a solution for when I'm helping a client to deal with whatever problems come up, whatever challenges come up when we are helping them purchase a home, and they will come up now.
Yeah, well, for me, I got my real estate license back in 1998. And the reason that I got my real estate license is because of what you mentioned. I looked around at my peer group. I looked around throughout my family. Those that were in my family that had purchased property, they hadn't bought anything in a number of years. And so their knowledge about the process was dated and it wasn't relevant for the time. And my peer group, at the time, they were not even in the mindset of buying real estate. Some of them hadn't even gotten their first apartment yet. And so, for me, I didn't have what I would say would be a credible resource that would help me navigate the process and answer some of those challenging questions with what you said is, a lot of times the largest purchase that an individual might make. And so for me, it was really important that, I become that resource that was not available for myself. And so that's why I took the class, was not only to help me along the way, but also to help those in my peer group that would need a resource, and then of course family members that might need some as well. And over the years, I've learned a whole lot of stuff and seen a whole lot, and I'm glad to be here to share some of that stuff.
Man, absolutely, man, and we appreciate you for doing it. And I think that's an important principle that you highlight there. When you are not the resource, when you don't have the resources, you become the resource. And now, because of your focus on that, and you got in the game early, man. A lot of people weren't even, like you say, thinking about getting into the real estate business, let alone purchasing a home. And so, what's that first step? What do people need to do when they say to themselves, "Okay, I have a job, I have some steady employment, whether it's a job or self-employment or entrepreneur." What's the first thing they need to do to start that home ownership process?
Well, I would say the first thing that everybody needs to do is stop listening to other people that, that are not professionals. I'd say that at least 75% of the people that I come into contact with believe that they cannot buy real estate when in actuality they can. But they're listening to other people, within their sphere of influence, their concerns about credit or concerned about down payment or some of the things that are definitely important, but they may not be as important as people might think that they are. There are lenders that are very aggressive about lending, that lend money to people that have less than perfect circumstances or less than perfect credit, I should say. And whereas credit is one of the factors that's to be considered, but there are other factors that the lenders consider when analyzing an individual to determine whether that individual would be allowed to use their funds to buy a home. And so I would say, number one, you want to surround yourself around professionals. A lot of people say, well, my credit. And so my question is always, well, who told you you had bad credit? Because, a lot of people have subscribed to Credit Karma or some of these other programs that give you access to your credit, and they give you credit scores. But what a lot of folks don't know is that credit scores are industry driven or industry specific, I should say. And so if you go to finance an automobile, well, when they run your credit, they're analyzing your credit with respect to the repayment of that automobile loan. If you go to a mortgage lender, they're analyzing the credit based on that. So you might get a different score if you go for auto finance versus a mortgage finance. And so the first thing that you have to do is, if your concern is with credit, you need to speak with a lender that finances real estate and have them to pull your credit to see what your credit would be if you were to get a mortgage loan, as opposed to other types of finance in other industries. And so that would be the first thing I would say, is that you have to do a credit health check, right? And make sure that you have the credibility to go out and get a loan. And just because the lender says, oh, your score's too low, well, that's not the end of it, right? Because there's other components to be factored in there as well, like your down payment. I remember when I went to buy my first car, Well, when I went to buy the first car, I went to the Honda dealership and I wanted a Honda Accord. And they were like, well, you have a low credit and you got low down payment. You can't have it. And so I said, okay, well, what if I give you more money down? Mm-hmm. Well, they're like, okay, well, that's a whole new conversation, right?
Right.
And so, where your credit might be a little less than perfect and maybe not where the lender might want it to be, what you could possibly come up with a little bit more down payment, and that might make the difference for you. And it's not necessarily just the money that you have in your bank account that's liquid. I mean, a lot of folks have worked at jobs for 10, 15, 20 years, and they've contributed that 5 to 10% to the 401k or the deferred comp or whatever it might be within that corporation. And those are funds that can also be used for initial home purchases. And you can, a lot of times, you can use that money as down payment or closing costs, and you can withdraw it from the 401k without penalty as long as you're putting it into real estate. So, I mean, those are some of the things that I would say initially are going to be a part of the conversation when you talk with a credible professional, is talking about getting your credit house in order and making sure you have an adequate down payment for the price point that you might be looking at.
And what's the average down payment if, let's say, we're talking about a $200,000 house?
Well, in our market area, actually, the market in Chicago, in the Chicagoland area, average home prices are roughly in the 200 to 250 range. That's about how much it costs. And what that translates into the form of a monthly payment is usually going to be somewhere between $1,200 to $1,500 a month, which happens to be about the same as that people are paying for rent in the same market area. So, that's another component of it. A lot of folks are paying very similar to what it would cost to own the home. They're paying that in the form of rent. And so I would say that.
Wait a minute, please say that again, brother. Say that one more time.
Yeah, that's the reality. A lot of folks in Chicago, if you're paying rent between $1,200 to $1,500, which is about the standard for a 3-bedroom, and you're paying between $1,200 to $1,500, that translates to about a $200,000 to $250,000 mortgage, depending on the neighborhood in Chicago and what the taxes are in that particular neighborhood and the insurance costs in that neighborhood. So, but it roughly hovers somewhere between $1,200 to $1,500 a month, will net you about a $200,000 to $250,000 mortgage, which is a really nice house in a lot of neighborhoods.
Right, exactly.
And
so go ahead.
So what I was going to say is that most people, in the first-time buyer market, they're going to be looking at a minimum of about a 3% down payment, and that's if you're going FHA. But there are other lenders there are other programs, because going to the bank is like going to McDonald's. It's like they got a menu, right? And so FHA is on the menu, conventional is on the menu, and other programs are on the menu. Well, FHA, you got to have at least a 3.5% down payment. A 3.5% down payment. But there are other lenders, conventional lenders, that offer 3% down, 5% down. And so on a $200,000 place, you're looking at between $6,000 to $10,000 for down payment. Mm-hmm. But there's also closing costs. And that's something that most people kind of negate in the conversation. Like, the person has to come up with their down payment, but in addition to that, they have to have the closing costs as well. Now, in Chicago, definitely on the South Side, it's very common that the buyer asks the seller to contribute something towards the closing costs or down payment. Mm-hmm. And a lot of times we get it. As real estate professionals, we tell the buyer, ask for, some money from the seller. And a lot of the sellers will do it just to get the deal done. And so out of let's say it costs on average maybe about 6% or so for the buyer, 6 to 7% if it's an FHA deal. Well, if it's 7%, that's about $14,000 on a $200,000 place. And that's about what it would look like for down payment and closing costs if someone's going FHA on about a $200,000. It'll be somewhere between, $13,000 to $15,000. But if you were to ask the seller to contribute, $5,000, that means you're only coming up with about $9,000, $10,000, mm-hmm. which is not a heck of a lot of money. When I say it's not a lot of money, it's because I've seen people's tax returns. They're getting, $3,500, $4,000 with that child income tax. The earned income credit and all of that kind of stuff. Well, I mean, that could be a quarter or a half of the down payment in itself. So, people have the resources. If you look at that tax refund, the money in the 401k, and some of these resources that people have that they're not utilizing, they may have what would be required to fund the transaction with a little bit of support from the seller. And the neat thing about FHA loans is that they allow the seller to contribute and participate, and they also allow contributions from other parties, right? If you have a family member, if you have a spouse, you can borrow money, or excuse me, they can give you money, not borrow. They can give you money in the form of a gift that can be used as your down payment and closing costs as well.
Man, okay, so I love this conversation and break this down because this is what I've run into with some of my clients. The challenges and the differences between an FHA, a VA loan, and a conventional loan. And at times where they have an FHA loan, they may be demanding or wanting certain things that they may not get because the seller has to, jump through a few more hoops.
Right. So with the biggest concern that sellers have, because you got to look at it from the seller's perspective, the biggest concern that sellers have, most of the time in this market, is the repairs. When you are going to finance and you're going to get a loan from a lender that's going to be a FHA loan, well, there's a appraisal process that you have to go through. And with that appraisal process, it's really kind of like an appraisal and an inspection at the same time, because the property has to meet the health and safety guidelines of the federal government. And so they're looking for things that could potentially cause harm to the occupants, like lead paint, trip hazards, or faulty electrical, faulty plumbing, or any of that kind of stuff. And so with an FHA loan, if it's revealed that there are some things that could have a negative impact on the health and safety of the occupants, well, they're going to want those items to be addressed prior to them closing on that deal. And so because of that, you have sellers that, you have real estate agents that, give advice and counsel to the sellers, and they may be a little more reluctant to accept the buyer's offer when you have FHA financing in this market. And it's really a market driven because right now we have a very low inventory environment. And because of that, if you're seeing multiple offers on the few properties that are available, and when you have those multiple offers on the few properties that are available, they're going to analyze each of those offers based on the merits of the offer.
Right.
And so if I'm working with the seller and we're looking at 5 offers, and I got 3 of them are conventional, 2 are, let's say 2 are conventional, 2 are FHA, and 1 is cash. Well, we're going to get rid of the FHA ones because of the hoops that the seller might have to jump to, or the repairs that might be necessary. And then we might look at the conventional ones versus the cash. But ultimately, most sellers would go with cash because it's the easiest transaction and the fastest to close, and it's not dependent upon the buyer getting financing. And so in a competitive market that we're in right now, of course, people that have cash are going to be king, and those that have conventional loans are going to probably be next up to the plate, and then we'll have FHA loans. But it doesn't mean that because you have FHA financing, you're not going to be able to win. This year in 2021, I've been successful in getting quite a few people properties that have FHA financing, and with some of them, we've even paid below market value. Below list price, I should say, below list price, and gotten the seller to participate. And so, some of it is number one, having a quality real estate agent that. And it definitely is beneficial when you have a quality agent you have a really good relationship with, and and they're working in concert with the lender, to basically present a picture of the borrower, the buyer, that would be acceptable to the seller, right? And so if you're doing FHA financing because of the low down payment and some of the benefits of the FHA financing, well, you have to be able to paint that picture to the seller and sell that to the seller. And of course, your offer has to be pretty strong, with that being the only thing that they might have a problem with.
Oh, man, that's beautiful. We're going to get back to these steps in a second, but I do want to ask you too, to go over the challenges that people have. Let's say um, the message that's going out today, because people are able to sell their homes right now for a little bit more than they may be able to in a different market, because it's a seller's market right now, right?
Right.
But at the same time, as you just kind of alluded to, there have been a bunch of houses being sold. Despite it being a seller's market, people are buying and buying. And I read one report that said that Chicago and Illinois is leading the way,
Well,
right, in home sales during this pandemic.
you know, it's really funny to me because one of the questions that I get a lot, whether it be teaching a pre-licensed class to people that are seeking a broker license or talking to buyers, the number one question that I would say that I've been asked is, and this is I've been in the business, January will be 24 years.
Mm-hmm.
This is the number one question I've gotten over the 24 years. Is this a good time to buy? It's the craziest damn thing I ever heard. Is this a good time to buy? And in my brain now, I don't tell people this, and I just think it every single time. When is it not a good idea to have a roof over your head? When is it not a good idea, right? Housing is a basic human need. It's always a good idea,
Right.
to buy a house, you know, and to have somewhere to live. It's always a good idea to have investment property that would get you a residual income. And so, you know, the idea of whether it's a good idea to buy or not it's crazy. It's always a good idea to buy. It's always a good time to buy.
Mm-hmm.
But it's not. But it's property driven, right? Every property for sale is not a good deal. There's
Mm-hmm.
good deals in any market. I don't care what the market is. There's some good deals out there. There's some properties that are going to appreciate and
Right.
have future value.
Right.
There's going to be properties that you can rent and get residual income in any market. But you have to buy right, you know, in order for that to happen.
That's
and
the
that's
key,
where
buying right.
it's heavily dependent on that real estate agent or professional that you're working with, that they
Mhm.
go out and source out the quality opportunities in this hayfield, if you will, of
Mhm.
properties that are available.
Mhm.
You know, there's some properties out there that are bad ideas. There's some out there that are awesome ideas, you know. And so whether you're an investor or an owner occupant seeking the American dream, either way, you know, there's some awesome opportunities in any kind of a market.
Mhm.
And so, of course, you know, one of the things that we have to look out for in our community, and we have to look out for those people that are coming in our community, doing these fix and flip renovations, putting crappy stuff together, and then selling them at a premium. And those are the situations that cause the problem, because people are buying properties that are overpriced.
Mhm.
They're paying because of what they see without knowing what's behind the scenes.
Mhm.
And that's where it gets a little precarious. And that's why you have to be careful, and you need some quality folks around you. You need a great home inspector. You need a great lender. You need a great real estate professional, so that they might be able to identify some of these things that could be future problems for you. Like I know someone that bought a place, it was a rehab, and on the surface, it looked great. Had a little issue with some plumbing, had a plumber come out there, and they said, yeah, on the outside of the wall, you got copper. On the inside of the wall, you got galvanized pipe. So they didn't actually give you new plumbing here. They just attached to the end of the plumbing, right? And so you got some contractors out there that are doing shoddy. I call them Jimmy Riggers Incorporated. You know, they're out here doing some work that's
Jimmy
just
Riggers.
not right. You know, and so you got to watch out for those folks. But at the end of the day, you know, if you have a good team around you, you can definitely buy property.
Right.
And you want it to be like, if you're buying right now at 200,000 and the plan is to live there for, you know, 5 to 10 years. Well, you want 5 to 10 years from now, you want to be able to either sell that thing and make some money off of it, or you want to be able to rent it out and get the residual income. And but you want to have been placed into a good situation where you're not going to be looking at foreclosure or short sale where you're underwater and you've paid more than the market might bear for the property within the next 5 or 10 years or so. And that's the and I think when people ask me, is this a good time to buy? That's what their concern is. I don't want to overpay. I don't want to, you know, in the future be in foreclosure or be underwater. And so that's what the concern is. And that's all about the acquisition. right? And that's where you have to really, really work hard to find that little soft spot in the market where you can buy a property and you can have that future equity position or future residual. And that brings me to the thought, well, is it better for somebody to buy a property that's been renovated, move-in condition, or is it better for somebody to buy a property that maybe is in distress or deferred maintenance or maybe hadn't been updated in a while? And I support that it may be most beneficial for most of us to buy a property that may be a little dated, maybe not the newest, brightest, shiny item, and do like our
Hold on, man.
parents
Hold on.
and
You're
other
talking to
people
black
do.
folks. Talking to black
I know,
folks
right?
now.
I want to ball out, right? And so, but
We want new everything.
I know you do, right? And so, what I think is that what we have to kind of get back to is some of the stuff that our people did before us. They bought a modest home,
That's right.
and they made improvements on that thing over time, and they received that future equity.
Yep.
Like that's one of the things I did. I did this with my mom. I
Mhm.
sold her a very small, modest little home, and every year we did a project. One year we did the kitchen.
Mhm.
One year we did the basement. One year we did the furnace. One year we did the roof. One year we did this and did that.
Right.
Well, right now she's sitting on quite a bit of equity on this
Right,
property
right.
as a result of that. Now, if she'd have bought that thing, bling bling, all of that kind of stuff, well, she would probably be. Let's say she paid. Let's say if she'd paid $1.30 for it.
Mhm.
When the market went down, it went down to like 100,
Mhm.
and now it'd be back up to the 130.
Right. Right.
And so she hasn't accomplished very much of anything.
Right.
But if she bought that thing
Low
for
in the
100
rows.
and did that work over it, and now it's worth the 130, 140, 150, well,
Yeah.
now she's got some equity in it that she can, use if necessary, and she can tap into that.
Right. So, man, this is a beautiful discussion. So, all right, let's kind of go back to the steps a little bit. So you talk to a professional realtor, right, and get that consultation. Then you get pre-approved.
That's right.
By a mortgage company, bank, and get the right loan that's good for you.
And figure out how much you can afford and all that kind of stuff.
Right. Figure out how much you can afford, and the loan company is going to help you figure that based upon your assets and your income and all that. Right. So now, what's the next step?
Well, the next step now it's kind of so you go to the real. A lot of times it starts. A lot of folks today are starting at online. They're looking at homes on these various websites, and then they talk to the real estate agent.
Right. Right.
And so when they come to me, a lot of times they already know a whole lot of stuff, and then some of it is true, some of it's not true, and we have to do a little bit of correction there. But some of them might come to me with a lender in mind, and some of them might come to me seeking a referral for a lender. Either way, once they talk to me, they're going to the lender, and then they come back pre-approved or pre-qualified, and they know how much their budget is. They know what the affordability is, how much it's going to cost them on a monthly basis, and then we start to formulate some criteria. And that's the value of having a quality real estate professional is that as a buyer, what you want is that real estate professional to sit down with you and do a consultation.
Right.
And you're going to tell the real estate agent all your dreams, wants, and desires. And the job of the real estate agent is to take those dreams, wants, and desires and chisel them down into a realistic, attainable reality, right? Because some people have pretty lofty dreams and goals, and reality is like, right, they got the beer budget with the wine taste, right?
Exactly.
And so sometimes you got to chisel a little bit and get it down to reality. But once you've formulated that criteria and in consultation with a professional, that's skilled and trained, well, then now you got a realistic, attainable reality.
Right.
And so then, you're going to rely on that real estate professional to go source out properties that are in alignment with that criteria that you guys have formulated using their professional expertise and local market knowledge, so that because they know what's out there and what's available. And so that's how you're creating the criteria. And then they go out and source out those properties. And then once they source out those properties, the next step is that the real estate professional, let's say you got 10 properties, they should schedule, they call them showings. It's crazy to me they call them showings, but because for me, they're not showings. What they are inspections. They're little micro inspections.
Right. That's what they are.
Because what we're doing, is we're going to those properties with them, and we're going to use our professional skills and expertise to take that 10 properties and beat it down to the one property. So we're going out trying to eliminate properties using our skills and market knowledge, and we're thinking and considering about the criteria and all of these different things, as we eliminate these properties to get down to the one that we would recommend to be the best one for them and that they agree is the best one for them, right? Because ultimately they choose the home and or the home chooses them. I don't know which way it goes.
Right.
Because sometimes they walk in the door, they say, this is home.
This is
right.
calling me.
And
This
I
is
don't know,
calling me.
right? But they definitely know when they find it, this is the one.
That's
and
right.
so now that we have, this is the one, well, the next step is that the professional, the real estate professional that is working in partnership with you as your partner in crime here in this home buying opportunity, well, that person now is going to do or should be doing a market analysis to substantiate the value of it, right? They should be going out into the marketplace, finding other properties that have recently sold in that particular market area, so that we can substantiate what we should offer for the property.
Right.
And so once that professional has told you what the market range is, right? This thing is worth somewhere between 2 and 2.25, and it's on the market for 2.25. And then the buyer says, okay, can I offer 215? We say, great, we'll go with 215, and we'll ask the seller for $5,000 of closing costs to help you with your, close the transaction. And so then they, develop the offer, communicate the offer to the other party, and then, negotiate with the other party to come to the terms that would be agreeable to your buyer, to the buyer and to the seller. And then you have an agreement here, and once we have the agreement, of course, now we're going to get ready to do all the other stuff we got to do, like finalize the loan stuff. We're going to organize the inspections and things like that to go assess the property, try to find all the defects. And once all of that stuff is done, and which all creates value for the buyer, right? I mean, you have a professional that's going to an inspection and representing you and looking to make sure that that inspector is doing their job.
Right.
And I tell you guys, if you're out there and you're buying a house, your real estate agent should be at the inspection.
Right.
Right.
I'm in all of mine.
Yeah. And because you need somebody to overlook that process for you. Because if you're a first time buyer, you don't know what the inspector is supposed to do.
Right. That's right.
But the real estate professional knows exactly what that inspector is supposed to do. And so we should be shadowing all around, making sure they're doing their job.
Right.
Protecting the buyer's interests.
That's right.
And
for me, it became a learning experience.
Absolutely.
Because now I have an even better eye of how to look at furnaces and water heaters and some of those core things and what to look for, because you got the right inspector. They'll give you tips.
And that's exactly why instead of calling it a showing, I call it a micro inspection. Because I'm looking for water stains. I'm looking for inoperable anything or broken anything or cracked anything. And a lot of that, while I'm walking through the house, they're looking for a house. I'm looking for problems.
The beauty of it.
Like, wow, this kitchen. I'm like, well, that outlet needs to be a GFI. Right? It's within 5 feet of the sink. Right. And so for me, it's more or less a micro inspection. And so, I mean, as a buyer, you rely pretty heavily on, your agent to point things out like that,
Right.
But once that inspection stuff is over with, the next step, is to work with the lender and organize for the appraisal and, and get prepared for the closing of this thing. And then, of course, there's going to be a final walkthrough, and you want to assess the property once again to make sure it's in the same condition it was in when the buyer first originally saw it. Because sometimes this final walkthrough could be 30, 45, 60 days after they had initially seen it.
A lot of stuff can happen in that time.
A lot of stuff can happen. Like they could swap out the appliances on you.
Right.
And so,
we had experience my last deal.
Yeah. So, I mean, you want to do that final walkthrough.
Right.
And then,
they put a hole in the wall.
Oh, wow.
There was a hole in the wall that was not there previously.
Oh, wow. Yeah. Well, I've seen some pretty crazy stuff. Like I did have one where the seller swapped out the appliances. They were like some beautiful brand new appliances when we first saw it. And then there were some used appliances at the end because they were upset that it didn't appraise out. Let's say that they were selling it for 200, it appraised for 190.
Right.
And so they dropped down to the 190, and the seller was mad about it, took all the appliances out and put some used appliances in there. And so, luckily they had this awesome real estate agent. My buyers did, and that's me.
That's you, right?
And so when we go for the inspection, a lot of times I have the buyer take pictures of the appliances and stuff.
Mhm.
And so we were able to substantiate that they had swapped them out on us, and and they didn't. They ended up keeping the used appliances, but we ended up getting a pretty substantial credit at the closing.
See, they
And
had even
so,
less than they thought they were
they
going
paid
to get.
even less than they thought that they were going to pay. So, and then ultimately,
And that's part of the contract too, right? When you write up contract, you say the things that you saw that need to stay there in order to make this deal go. So they literally, well, somebody should have known that they were doing something that was improper.
They tried to get us, but they didn't. We won. Yep. And and the thing is the relationship that the real estate agent has with the buyer is so critical.
Yes.
Because the real estate agent is the one person throughout the transaction that's always involved.
Right.
You start the transaction with them, you go source out properties and do all this stuff with them, and you're the only real human nowadays. You're the only human that the person is actually has an ongoing continuous contact with.
Right.
In the past, the buyer might have a relationship with the loan officer, might have a relationship with somebody else, but it's not like that anymore. Most people go online to get the loan.
Right.
Most people don't meet the attorney, the buyers.
Now, let me ask you about when you talk about loans, what do you prefer? I know just in general, because I'm kind of old school, I like a loan company that is local, that has somebody here. It's some that are national and all that. What are the pros and cons of that?
Well, I lean very heavily towards local financial institutions. Usually, first of all, they have a vested interest in the community. They have a relationship with people in the community because they're taking in those community deposits. And a lot of times they have programs that you don't see on their menu. Remember, I said they have a menu, right? So a lot of these local lenders have programs on their menu that might not be available from some of the national lenders. And so I agree that you might have a better go at it, especially if you have some credit challenges and things of that nature. You might have a better go at it using, a local lender, a community-based bank that doesn't have a national presence. And there are quite a few of them that are really doing a good job in our market area, that are doing pretty good. They're kicking butt, that I use quite a bit. I refer to it quite a bit.
Beautiful. All right. And so, and you talking a little bit about the team, right, that you need to have in place. So of course your lender, your inspector, and your attorney, right?
So
and
the thing about
if you don't have though, if a person doesn't have that, usually a good professional realtor is going to be able to plug you in with some options that you can choose from.
Absolutely. Like, the real estate agent should have, relationships with lenders, several lenders, several attorneys, several contractors, several, inspection companies. And of course, there are folks that they might use a little bit more frequently, but there should be an option by the buyer to use a variety of places, and I usually give them 2 or 3 referrals that, for whatever it is that they're in need of.
Right.
And, I was going to say about the attorney is that a lot of buyers nowadays, they don't even meet the attorney, and sellers as well.
Right.
A lot of buyers and sellers don't meet the attorney until the closing.
Right.
So that's a lot of times somebody that they don't have a relationship with. They don't even know these people. They're strangers. And so that's why, again, it's most critical would be the relationship with the real estate professional, because you don't know the lender, you don't know the attorney, you don't know the inspector, you don't know any of these folks.
And look, and with COVID, even the attorney now, they're meeting them for the first time on the phone, talking to them on the phone.
Man, one of the craziest things, I had a deal where the attorney did not come to the closing. The attorney says, well, because of COVID, I'm not coming. And I'll help you. I'll go over the paperwork with you over the phone. I was like, what? Are you crazy? I just got my license this year, right? So that's the normal. That's the normal for me. So that's crazy to me. That's absolutely crazy to me that the lawyer is not at the close. And like, I've been asked not to come before, which is weird to me. In my 24 years, my goal is to go to all the closings. And so this whole COVID, you can't go. I felt like a kid, like being locked out of the candy store. Like, man, why can't I come in?
Right.
And but generally it'd be at least the buyer and the buyer's lawyer there.
Right.
And the closer. even with COVID, the seller's usually not going to be there with COVID,
Right.
and the seller's attorney may or may not be there with COVID,
Right.
because they can pre-sign all of their documents, the day before, the week before, what have you,
Right.
and have all that stuff already done. But all of the buyer stuff pretty much has to be wet signatures, right? And so the buyer has to be there, of course. The closer has to be there. And I think it's the right thing to do if you're the lawyer to be there as well.
Yeah.
And unfortunately, they've been saying that the real estate agents can't be there, but and it depends on the title company. Like,
Yeah.
I did do one just recently, and we were able to go, and I was so excited, But
I showed up all mine.
yeah,
I'm
well,
here.
I mean, it definitely benefits us to go for a variety of reasons. I can't imagine how many closings that I attended that would not have closed if I wasn't there.
Mm-hmm.
Right? It's really incredible. I mean, little small stuff, that could prevent a deal from going through.
Right.
Well, I was there to kind of figure it out and make some sense out of it.
Right.
Working with the attorneys, working with the other party to get the deal done. Like, no, we're closing this thing. And so, I think it can be very critical in certain situations that the real estate professional is there, and of course, it's a valuable relationship,
Right.
And if the real estate professional is doing all the things that I mentioned, that's somebody that the buyer is more likely to refer to somebody else.
That's right.
And I think that that's one of the things that if nobody's referred you to that real estate agent, I would be concerned about that. If you don't know any real estate agents, you probably want to use a referral, somebody that they did a good job for,
Exactly.
and they closed the deal. I mean, use that agent if you don't have one of your own.
Right. That's right. And look, I keep saying this, but I'm new to the game of real estate, but I've been a professional for a while and an entrepreneur. And I'm seeing there's a lot of opportunity for me to rise up fast because some of these realtors seem like they just started yesterday and don't have good people skills.
Well, I think that what's most important in this relationship is communication, right?
It is.
Having an open line of communication, and for us, it could be it could be kind of rough, for us, depending on the volume of business that you take on. And that's one of the things that I refuse to do. I refuse to take on more than I can handle. I usually work with just a couple of people at a time. If it were best case scenario, I'm working with one buyer at a time.
Right.
But sometimes, it could be two buyers that I might be working with, but I really limit the number of people that I'm working with so that we can have successful transactions and they can have the amount of time that's needed as individuals, because you got to have an open line of communication. When people have questions, you got to get them answers.
That's right.
And when people want to see properties, you got to get out there to show them those properties that are available, because in this market, they're not lasting. They're hitting the market and they're, under contract within a week or so.
That's right.
And so you got to kind of be able to respond very fast. So if I'm working with 10 different buyers, somebody's going to fall through the cracks here and not get a property.
Right.
And so that's one of the worst things to me. And so I'd rather, work with less people, which is maybe means I'm going to make less money, but I know all of those people are going to be in good situations that are sustainable. And I think that's what's important. I mean, like people like you and I, we want to create sustainable housing opportunities because we understand that this housing thing, it makes a huge difference, not just in the life of the buyer, but in the family of the buyer, right? That generational wealth transfer. One of the biggest significant differences of the net worth of a Black citizen and a white or Asian citizen is the equity in the family home.
Right.
They have owned property longer than us, so they have more equity than us. They have more wealth than us, and they transfer that wealth to the next generation. And we have not had the ability to have that wealth transfer. And so, this is an important thing for us. It's not just for our current, but for the future of our people.
That's right.
Is that we have to get into this home ownership, this property. It's not just necessarily home ownership, but property ownership. I mean, as a kid, I grew up in Chatham. Well, everything in my neighborhood was owned by Black people.
Mm-hmm.
All of the buildings, all of the businesses, everything was pretty much owned by Black people.
Mm-hmm.
The gas stations, the grocery stores, the
Yep.
dry cleaners, the bars, the restaurants, the bowling alleys, or
Yep.
the billiards halls, and all that stuff was owned by Black people. And so that's the frame of reference that I have, is that I know that there's the potential that we can own the whole neighborhood.
That's right.
Because that's where I grew up. We owned the whole neighborhood.
That's right.
And so, there are significant opportunities in retail, all these vacant storefronts up and down the commercial corridors. I mean, we need to buy them and occupy them, just like we need to buy and occupy these vacant homes in our neighborhoods, because there are other people that are looking at those properties and seeing the value of those properties, right?
Right. That's
And
right.
so, I look at communities like Inglewood, or where you have a confluence, you have a convergence, I would say, of
Right.
people that are stomping into that community,
Right. That's right.
from other neighborhoods because of the opportunity.
Right.
I can get a graystone in Inglewood for $100,000 or less that might need a renovation, right? And I put 100,000 into that thing, and so I bought it for 100. I put 100 into it. That's 200,000, but that thing's worth 300,000.
Right. Right.
Right. And but when we look at it, it's like, I don't want to go to Inglewood. I don't want to go to Roseland.
Right.
Well, there are a lot of people that are lining up to go there, in spite of the fact that we are trying to get out of there. You got people coming in
There's people
droves to
coming
take
in.
advantage of the land opportunity. It's a land grab going on.
That's right.
And it's been going on for a couple of decades now.
Yep.
And we've seen the results of that in some of the communities. You look at the South Loop and the Gap area; it was all Black people. You look at Bronzeville and some of these other areas, and
Man,
there's
that has-
definitely gentrification going on.
Yep.
And gentrification in itself is not bad. I mean, I look at parts of Bronzeville. Well, you got working class Black people that are buying those $500,000, $600,000, $700,000 places
Right.
in Bronzeville.
Right.
So there is gentrification that's happening in Bronzeville. You got people that are being are leaving the area, and you got people that are coming to the area, but they're all Black people.
Right.
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 And so it is gentrification, but it's not gentrification that is.
It's not ethnic cleansing.
It's not ethnic cleansing. Yeah, I like
If
that.
you
I like
will,
that.
right.
I like that. I love it. I love it. It's not that. Right. And so it doesn't necessarily have to be a bad thing,
Right.
And we have so much opportunity.
That's right.
I got
That's
some
right.
buddies that's doing some building, and all the land we have is unbelievable.
It's a lot of land that's
Lots of
available
land. Lots
for,
of land.
for residential and commercial. So, and I got a story about a friend that was living in Regents Park, in
Okay.
Hyde Park, right?
Yeah.
They were on an elevator, and there were two elderly couples talking, white couples. They were at least in their mid 70s. And they said they were moving out of Regents because they saw a wonderful opportunity to move. And where were they moving? Bronzeville.
Wow.
At 75.
Wow. Because they see it.
They were buying a
see it.
home in Bronzeville.
They see it.
Yep.
Well,
So, but look, let me tell you, before this, I want to make sure we hit these few other points now. Right. So you have your realtor who has gotten you through the first phase of buying a home, which is we looked at the home, the home inspection is done, a contract is put in, and now they got to hurry up and wait. All right, what's that process? And because that is some for the clients I've had so far, that is some of the most nerve-wracking parts because they're just waiting.
We're waiting on the closing.
Right. Once the deal is accepted.
Yeah.
Right. And now they
So
got to
you're
go
going
through the
through the
process.
underwriting and all that.
Underwriting, yes.
So that part can be a little maddening, to say the least. And what I try to do is, and a good real estate agent will prepare the buyer for this process, because what I found over my time in the business is that the more you inform someone about the process, the less likely there'll be conflict, confusion, and questions along the way. And so, you won't have someone being upset about whatever the length of time they might have to wait if they knew in advance that they would have to wait that period of time.
Mhm.
And so I think that, the quality real estate agents will provide like almost like a timeline, if you will,
Mhm.
of what the transaction would require. And they're going to put realistic timeframes on the contract.
Right.
Like, you need at least about 30, if the person is borrowing the money, well, you need at least 30 days for what's called the mortgage commitment, right?
Mhm.
It takes at least 30 days or so. And then from that, it might be another 15 days for the underwriting or, to happen, because you're not the only one that's borrowing the money. You're in a line, basically. It's a line to see the underwriter.
Right.
And what is the underwriter looking at? Well, they're looking at all the documentation that you had provided when you did your application, right? And one of the problems that a lot of buyers have is that they've submitted all this stuff to the lender, and then it gets into this underwriting phase. And then now they're saying, give me these documents again, right? Some of the same stuff all over again.
Right.
Like, I already gave them that stuff. I gave them that
Why
stuff.
ask me again?
And so, but the thing is that the underwriter's just following the rules. There are guidelines that the underwriter has to follow in order to approve the funding of the loan. Because the part that a lot of people don't understand is that banks are borrowing money to lend the money. And the people that they're borrowing the money from give them criteria.
Right.
They say, we need all this stuff.
That's right.
You get all this stuff from the person, then you can loan them my money.
That's right.
But if you don't get this stuff
Right.
and you loan them my money, if they don't pay you back, we got a problem.
We got a problem, right?
And so it's that part that a lot of people, get hung up on, is that underwriting thing.
Realistically, if you got pre-approved in April and we start looking for your home, but somewhere in the middle of April or towards the end of April, you decide to buy a new car.
Oh man.
You decided to do something that changes the whole algorithm.
Right. Now
that you were pre-approved on.
In the underwriting.
So the underwriters now they want to see making sure this stuff is current as well, right?
Yeah, that's
and you didn't do anything crazy.
It's totally critical that the buyer be the real estate agent, the quality one, will explain to the buyer, hey, while we're going through this process, don't go out and get a new credit card, don't go out and get a new car, don't go out and borrow any money from anybody. Leave it the way it is until we close this thing, and then go finance the furniture, finance a new car, go get 32 new credit cards. Who cares? But don't do that until we close the deal, because it could have a negative impact on you. You might have to go back through underwriting. It might change your debt to income ratio, and it's very plausible that your loan can be denied once you do any of those activities. And so, you want to make sure, as the real estate professional, they should be explaining all of this stuff to you so you're properly prepared to go into that lending situation. And if they're giving you this, if they're providing you with the proper information, you would be prepared for whatever the wait might be. Like, hey, we've got our mortgage commitment. It's going to take a couple of weeks for underwriting. And then after underwriting has issued what's called a clear to close, we'll be able to close this thing. But you want to, as a real estate professional, they should be setting up that timeline for the borrower or the buyer, and so that they have a realistic dates, and there's less disappointment or frustration on the part of the buyer, and explain to them up front, like, hey, if we started this, like your example was you started in April. Well, if you start shopping in April, you got your pre-approval from the lender, and now you're shopping through the month of April. Well, you're probably not going to find anything, because of the low inventory environment. And so it might get you into the month of May. Well, you get into the month of May, you find a house, you put a contract on it, you do the inspection and all that stuff, you're at the end of May. Well, all of the documents that you gave the lender, the bank statements, the pay stubs, all that stuff's a couple of months old.
Right.
It's too old. And so they have to get new documents to replace those documents.
Make sure you're still working.
It's just a part, right? You still got a job, right? It's a part of the process. But again, I think it's up to the real estate agent to explain this kind of stuff to the buyer, because nobody else is going to be there to explain it to them.
Right.
And so that's why we're there.
That's right.
And that's why we're the resource, But one of the things that came across my mind, while we're talking, is this going back to that earlier conversation about renting versus owning. And one of the things that I had looked at was a little study that was done by Fannie Mae, and it was comparing and analyzing the benefits or disadvantages of renting versus owning. And what it showed was, and it used a nominal kind of a deal. If somebody borrowed, I believe, $110,000, and the monthly payment on that would be $1,000 a month for the mortgage, and they compared that to somebody that was paying $800 for rent. Now, over the first 3 years, the person that paid rent was paying less. But at the 3-year point, it was like a break even. And from that point on, the person that owned the property was saving a substantial amount versus the tenant at about the 3 year period
Right.
is where, you know, things went sideways for the tenant, where the owner was benefiting from the fact that they owned because of the tax advantages and some of those benefits and the appreciation when
Right.
calculated in there. And
Right.
so you know, over the long haul, it's definitely more beneficial to own versus rent. Like I had a buddy that he was animate about renting in Oak Lawn. And so it was hard for me. This is a really good friend of mine, you know, and it was really challenging for me to get, I mean, it's hard for me to get people to do the apartment thing. Like, I'm like, man, dude, like, I really don't, I mean, this guy makes over $100,000 a year, and his wife, she wasn't working at the time, but she did have a master's degree, and she was just at home mom at the time. But at some point, she was going to go back to work.
Mm-hmm.
And so I'm thinking to myself, this is such a bad idea. They need to buy a house, and they need to have a backyard for the kid and all this kind of stuff. And it's way better than a stupid renting thing. But he was adamant about it. He didn't think he was ready. And my credit. I'm going to work on my credit. I'm going to rent for a year. Well, I found him a little condo. The rent for the condo was somewhere in the area of about $1,100 for a 2-bedroom, 1.5 bath condo in Oak Lawn. Well, they still live there. This was about 10 years ago.
Beautiful.
Right. And so in rent, they were paying roughly about $13,000 a year over 10 years. As 100 grand.
Right.
Guess how much they were selling the condo for 10 years ago? When we looked at it, it was for sale or rent, whichever one you wanted. Well, they were selling this thing for $99,000.
Wow.
So he could have bought the stupid thing.
Bought it.
and so now, let's say, for instance, if he'd have bought that thing 10 years ago for the $99,000, he would probably right now owe on a mortgage probably like $75,000.
Right.
And so that means that if he were to sell that thing today, in today's dollars, that thing is worth maybe, let's say, $1.25, $1.30. So he would have about $50,000 in equity.
Right.
So let's say if he was spending that's, you know, at $1,100 on a mortgage over the 10-year period, that $130,000 minus the $50,000 in equity, that means he only spent $80,000. Whereas with the tenant, he's not going to get any of that money back.
Right.
So he'll lose that $50,000, right?
Right.
And so it's a big old giant difference, you know, in rent versus owning. And over time, it's historically definite that if you buy versus rent, you're going to be better off.
Right.
No doubt about it. And then again, like I said, you can transfer that wealth to the next generation. I did a deal this year where they were girlfriend and boyfriend, and they were going to buy a place. Well, the boyfriend's mother and the girlfriend's father helped to contribute, so that they could buy this place up on the north side. But one of the conditions is they had to get married before the deal. And so so literally the week of closing,
New style shotgun.
it was crazy, right? The week of closing, they got married and then they bought a house, right? They got married and then closed on the deal with help from the parents, though. And where did the parents get the money from? Mom, the husband's mom got money out, got equity, right? She drew down some equity out of her property. The father drew down some equity out of his property, and they contributed that to the down payment for the kids. And so now they got a place up on the north side. It was very expensive, but it's got a boatload of equity in it, right? And they were able to get into that. And then both of them, with the equity that they have, they can give mom the money back, give dad the money back, and still have some equity. And the future, I can't even imagine that thing is going to be worth $2 million at some point one day, because of where it is. And they spent, they put up their little money, but without mom and dad and the equity that mom and dad had, it wouldn't have happened.
Right.
And these are white people. Right. And this is what we need to do more.
That's what we need. That's right. Man, this is a great discussion. We talk a little bit. We didn't mention this part, but it's part of the process. The reason and the importance of earnest money.
Well, earnest money is interesting. One thing about earnest money that most people don't know is that it's not required. Right? Most people don't know that it's not required. It's actually negotiated between the buyer and the seller.
Right.
But what earnest money is basically where the buyer is saying, I have earnest intentions upon completing this transaction
and fulfilling the promises that I made in the contract.
Mm-hmm.
If I were to fail to fulfill those promises that I made in the contract, I'm depositing this money that can be used for liquidated damages for the harm that I caused you by having you take it off the market and then failing to close on the deal.
Mm-hmm.
So what earnest money is monetary security against a breach of contract is what it is.
Mm-hmm.
You're providing the seller with monetary security in the case of breach of contract. And generally, the more of the earnest money, the more serious the seller might take you. And so earlier I talked about this year, I was able to get some deals below market and FHA when a lot of people have had a hard time with that. Well, one of the ways that I did that was increasing the earnest money.
Mm-hmm.
So that means the buyer is putting a little bit more at risk,
Right.
you know,
Right.
but you know, for us, you know, it's like, okay, you sure you want to buy it? Yeah. Well, you already got your financing. And so provide a little bit more of the money that you're going to be spending anyway.
It's gonna spend right.
And so if you got a
It's
3%,
taken from the closing costs.
right.
Right.
So if you got a 3% down payment, 3.5% down payment because you're going FHA, it's
Mhm.
200 grand. That's $7,000. Well, as opposed to putting a $2,000 earnest money down, let's put down 5,000. So the seller takes us a little bit more serious and put a little more skin in the game. And then when it goes to close, you'll get a credit for that
Right,
$5,000. And so it's not like it's going into some black hole or something.
Right.
You are credited for that
Right,
amount at the
right.
time of closing, you know, and it is a risky proposition, you know, because certain things could happen that could result in the loss of the earnest money. But a quality real estate agent is going to make sure those things don't happen,
Right.
and make sure that if things go, if it goes sour and the deal falls apart, that the buyer is able to get their money back. I got one right now where we're getting the earnest money back. It was a condo, and we found out that the condo association was kind of screwed up and they didn't have money. They were kind of broke. And so the buyer's like, man, I want to get out of this thing. I don't want to be a part of that. And so we were able to get them out. And right now we're getting the earnest money back. But there are mechanisms that can be placed in the contract that will allow the buyer to get out of that contract. And so when I'm representing the buyer, I'm looking for as many holes as possible that I could put in the contract. So if necessary, I could rescue that buyer and get them out of that situation.
Mm-hmm. Mm-hmm.
Yeah.
Man, this is a wonderful conversation, man. We covered all the steps, I believe, didn't we?
Yeah.
Yeah.
For the most part. You know,
Man.
I think one of the things that we need to also consider and think about is like with this rental property stuff. I get so many people that say, I don't want to be a landlord. I don't want to be a landlord. Well, I think that it's because of the way we view real estate. We don't view it as an investment. That's where there's a hiccup in the system here. Real estate is an investment. It's no different than investing in crypto, investing in the stock market, you know, or investing in mutual funds or any of that kind of stuff. It's up to the investor to decide what role they want to play in the investment opportunity.
Right.
And so what I think that most people need to understand is that just like with the stock market, you can choose, right? You can be a active investor. Like if I want to, I can open up a TD, Ameritrade account, or whatever, any of those companies, right? I can open up me a brokerage account and I could trade and I could do that stuff myself. I could pick the stocks. I could sell the stocks. I could buy the stocks. I could do all that stuff myself and be an active investor, right? And do it myself. Or I could hire a stockbroker that's going to do all that stuff for me, and then I get a check. Real estate's no different. You can be an active investor and you can go and find your tenants. You can collect the rent. You can oversee maintenance, updates, repairs, all of that crap. You could do everything all by yourself. Or you can hire a property management company and they'll do all that stuff for you and send you a check, right? So in real estate, just like in the stock market, you can be an active or a passive investor. And I think that has to change, right?
That's right.
The view or the lens from which, or the perception we have of ownership of rental property, I think needs to change a little bit, because you don't have to do it yourself.
You got to do it yourself. I think that's what some people think. They say, no, I don't want to be in somebody's apartment trying to unclog their toilet in the middle of the night. So they say, I don't want to be a landlord. They don't want the responsibility. And you just highlighted, you hire somebody else.
That's right.
To take on that part of the responsibility.
When I was in the property management business, well, I guess I'm still in it for, to some extent indirectly. But when I was actively involved in it and managing, I was managing a real estate company that did property management. And that's all they did, right? Was property management. And so I had owners. I had owners in California. I had owners in Arizona. Owners in Florida. They didn't do anything, and I talked to them like once a year. And every month we send them a check,
Right.
And then once a year is really just to kind of just chat with them,
Right.
But they didn't really want to
They
talk
still
to them.
alive.
All they want, as long as they got that check,
Right.
right? As long as they got that check, everything else they didn't really care about. But I would give them an annual report, and
Right.
have a discussion with them about some of the things that might need to be done over the next year or whatever, just to have some dialogue with them as opposed to email and text and all that stuff. And so you have a conversation with them or face to face, or you might even go walk some of the properties with them. But most of those folks, all they wanted was the check, and they could care less about everything else. As long as you were sending a check, they could care less about who was living there or what they were doing or any of that kind of stuff, And
Right.
so I think we have to kind of consider that as opposed to letting other people, buy and own the property. And I guess I managed a lot of property for people that were outside of our community, but they owned the property in our community. And I was like, man, we should own this stuff, and we should be able to do the same thing and take advantage of these opportunities.
Right.
Like I've seen in my time in the business, I've seen ownership decrease for the Black community, which is very sad. We were prevented from owning real estate for a long time. And then once the door opened, it went through the roof.
Right.
I mean, I have some friends whose family owns so much property. It's just incredible. On the South Side, West Side, they just had all this property. And then the next generation, squandered that opportunity.
Right.
And so now nobody has any property in the family. And we could get back to that. I don't think it's a loss forever kind of a situation. I mean, there's potential right now. And what I'm encouraged by is that I see younger people buying real estate, like in their 20s, like I did. I'm seeing younger people consider real estate careers. Like I'm incredible. I mean, I've got 18 and 19 and 20-year-olds in my real estate class getting real estate license. And I'm like, this is awesome. I wish I could have got my license when I was 18, 19 years old. I mean, this is the kind of stuff that's really can change a life,
Right.
And so I'm really encouraged by that. But I think we definitely got to get out of this mindset that, I don't want to be a landlord kind of a mindset. And because of the reasons we have for not wanting to be a landlord can be easily solved by hiring a property management company.
Right.
And you can still take advantage of that opportunity, get that residual income, get that future equity, and have that generational wealth transfer.
Man, so brothers, I know y'all hearing this, and I don't know if you all understand this, but you're really listening to one of the kings of multi-unit home purchasing. 3 flats and four flats. And so talk a little bit as we close out about the value. If you are a first-time home buyer, why making it an investment and getting that 3-4 flat may be a better option.
So what I always try to do with first-time buyers, and this is my thing. This is my thing. My thing is, if you're buying your first property, I personally believe that first property that you buy should be an investment property. It should be a 2-unit, a 3-unit, a 4-unit, because when you finance a 2-unit, 3-unit, a 4-unit, it's the same financing as though you were buying a house or a condo. It's the same thing. It's a residential property and it's residential finance. And so the lender gives you the opportunity to buy a house, buy a condo, a 2, 3, or 4, and the financing is pretty much the same. And the neat thing about the 2, 3, or 4 is that you're able to buy it. If you're using FHA financing, you could buy a 2, 3, or 4 unit and put 3.5% down. Well, now let's say you buy that thing and you live there for a year or so, right? Well, the other tenants have subsidized your housing expense. Either you're paying nothing or a very small amount. So for that year, the biggest expense that most people have is housing. It's like 25, 30% of your income. If you could eliminate that, then you get to actually have your income. And so you got your income over the first year. So you could save a bunch of money. And then you say, okay, well, now I'm going to leave this 2, 3, or 4 unit and buy a house.
Mhm.
Well, you can refinance the 2, 3, or 4 unit into a conventional loan from the FHA loan. So now you don't have a FHA loan anymore. So you bought it using FHA financing. You got a low down payment. You got a 3 unit. And then the next year you refinance that to a conventional. And so now you go shopping to buy the house.
Mhm.
Well, now you can buy the house with 3.5% down and use FHA financing again. And so you got your, now that 3 unit, one of the units or 2 of the units should pay for the building.
Mhm.
That other unit is going to subsidize the cost of that house. So like the first property I bought was a 2 flat over in South Shore. I rented out one of the units for $1,100 a month. The mortgage on the thing was $1,127.
Mhm.
So that tenant paid for it.
Right.
I lived in the other unit for about a year. Well, then I bought a house and I put a tenant in that unit for $900 a month. So I was actually making about close to like let's say $800 I was making out of that thing.
Mhm.
Well, the house that I bought over in Chatham, the mortgage on that was $1,200. So I applied $800 from the building to the house. And so I'm paying $400 for a wonderful bungalow in Chatham on a wonderful block.
Right.
For $400.
Right.
Right. And that's because
the
I
math.
bought the investment property first.
Right.
And then I bought the house. Now let's look at it as the other way around. Let's say I buy a house first and I use FHA. That's 3.5% down.
Right.
And I got me a house. And then I say, okay, well, I'm going to buy an investment property. I'm going to buy a 2 flat, 3 flat, 4 flat. Well, now they're going to want you to put down 20%. So by buying the 2, 3, or 4 flat first, you're able to buy it with a low down payment.
Right.
But if you try to buy it second, you're going to have to put 20% down.
And you're going to have to show more income. Right?
And you're going to have to show more income.
With the investment property, that's part of your income. You can show
It increases your income and makes you qualify for more.
Wow, look at that.
So it's a really
key.
Strategically. I mean,
Yep.
we're talking about strategy here.
Right.
And so strategically, it's much, much better of an idea to buy the 2, 3, or 4 unit first, because again, you get the low down payment,
Right.
and you get access to that investment opportunity. And then again, you don't have to wait forever. You could wait, a year or so, buy the house, that dream house or whatever,
Mhm.
and that thing is going to subsidize it, and you don't have to manage it. You can get a property management
Right,
company
right.
that'll manage it for you. And so, I mean, that to me, strategically would be the best situation for most people,
Mhm.
is to buy that investment property first and then the primary home. And I think we got to get out of this. I come across a lot of buyers that are looking for the dream home on the first home, which is incredibly challenging, right?
Right.
Because number one, it's unlikely that you're in a position to do the dream home thing,
Right.
right? And so it's a challenge in that part right there. The reality is that, like, say when I was growing up, when we were younger, most people stayed in the homes for 30 years. And that was because of the taxes. Like there was if back then, if you owned a property and you sold that property, of course you'd have to, if you make money, you got to pay what's called a capital gain tax. Well, for years and years and years, up until 1998, the only way that you could avoid the capital gains taxes up until 1998 was that you'd have to live in the home as your primary residence, and you had to be somewhere between, it was either 62 or 65 years old.
Mhm.
I can't remember which one. It was either 62 or 65. You had to live in it as your primary residence. You had to be like 62 or 65. You could sell one property in your lifetime and avoid capital gains taxes, but it was just once in a lifetime. So most people, by the time they got to the 65, they're like, screw it, I'm just going to stay here.
Right.
And that's why most people stayed in those homes for 30 years or so. And that's how we knew the people in our neighborhood. We had this relationship, and we built these relationships. We walked to school together, and we
Right.
had really strong communities back
Right.
then.
Right.
Right. The neighbors, everybody knew each other
Everybody knew
because we
each
were
other.
stuck in that neighborhood together all those
Right.
years. Well, in 1998, in the second Clinton administration, they changed the capital gains laws. And what they did was they said, well, if you live in a property for two of the most recent 5 years, you can sell that thing. As long as you live there for 2 of the most recent 5 years, you could sell that thing and a profit up to $250,000 if you're a single person, or $500,000 if you're a married couple that files joint taxes. You could sell that thing, make up to $5. So you could buy it for $100, sell it for 600, make 500, no capital gain tax. That's what happened in 1998. Well, when that happened, people started buying homes, staying in them for 2 years and selling them, making a bunch of money and leaving, right?
Right. Right.
And that's what created that thing called flipping. Flipping did not exist. Flipping properties did not exist before 1998. Right? It was because of this federal law that changed related to the capital gains taxes that created that flipping environment, right? And so that's when you had, folks coming from the north side up to Bronzeville, buy a house, fix it up, sell it, make a bunch of money, and then, just keep doing that process over and over again, and doing that flipping stuff. But prior to that, that didn't exist. And so, we can take advantage of that stuff now ourselves, right? Within our own communities, right? If we rehab the property and sell the property, if you lived in it, you could avoid that capital gains tax and make all that money. And so that's a good idea.
Yep, absolutely.
Yeah,
Man, wonderful, wonderful, man. I appreciate the conversation. I know people have got something out of it, and they'll continue to get something out of it because this is going to be up online. So, man, we appreciate you coming and sharing and having this conversation. We want to definitely keep it going. We're going to do something probably next month. We're going to do something maybe a little bit sooner with focusing on people who want to invest and who already got that mindset to invest. But we want to just make sure that we're giving this information to people who need to get out of the renting mentality and get into the home ownership mentality. So, man, we appreciate you for being on today to teach and to share some information with us, brother.
Hey, well, it's my pleasure, man. And, I hope that as we continue this, we get more people to get excited about home ownership because it is a very exciting thing. I mean, for me, at least it is, very exciting to think about the equity position that I've been able to attain and the potential of transferring that wealth, to my kids. I got a 29-year-old, a 20-year-old, and I'm molding them right now to get into this stuff, and that's another thing that we as parents have to kind of start to think about. Like, as I said, when I was in my early 20s, I didn't have anybody to go to give me this kind of information. And so I became the resource, but we have to be the resource for the youth, right? And we should, when our kids get 18 years old, we need to add them to our credit cards, right? And let them take advantage of our good payment history and all that stuff. Maybe don't give them access to the card, but you can add them as a user, and it helps.
That sounds a lot better.
Right? You add them as a user, as an authorized user, and it helps to build their credit, right?
Right.
And those are some of the strategies that other people have used to help and aid the next generation.
Right.
And we can take advantage of some of that stuff too. I mean, my 20-year-old's got a 750 credit score, right? It didn't happen because of the accident. It's like, hey, we need to start working on your credit, buddy, 2 years ago, and do some of the things to position you so that you can have the credibility, and so you have to mold these kids. I mean, we have to provide them with the information. And if you guys out there have children, 18 plus, I mean, they need to be listening into this and starting to position themselves to take advantage of this stuff because at 18 years old, you could buy a property, right?
Right.
And so anything beyond 18, of course, is a good idea. And so, what I did was I said, by the time, he's 20 years old, we should have, the ability to go out and buy some property. And that way I can get him out of my house too,
Right.
Yeah, but we're looking at like next spring, summer, he should probably be in a 2-flat. And I told him, like, make your little basement apartment, live in there for free, rent out the other stuff, make a couple dollars, and then we'll look at some more property, And so hopefully he'll amass a portfolio and be well further along down the line than I was at the same age, And then of course, hopefully he'll teach his kids the same thing.
Yeah, beautiful. Man, we appreciate you. We thank you, man, and thank you all for tuning in. And we'll be back another time, another day with some more of this stop renting, get into home ownership tips and tools and resources.
See you guys.
Peace.